You walk into a bank. Maybe you're applying for a mortgage, a car loan, a credit card with a higher limit. Doesn't matter. The banker across from you smiles, slides a form across the desk, and asks one simple question. What's your annual income? And you tell them. Of course you do, because why wouldn't you? You want the loan, you want to look responsible, you want to prove you can handle it. So you say the number. Maybe you even round up a little. And the banker nods, types something into their computer, and says, "Great, we'll take a look." Here's the thing. That moment, that single number you just handed over, you have absolutely no idea what just happened on the other side of that desk. And by the end of this video, you will. My name is Thomas, and I spend way too much time thinking about how banks actually make money off the people they claim to be helping. If you're someone who has ever felt like the system is rigged against you, but you can't quite put your finger on how, make sure to hit the subscribe button and give this video a thumbs up if this helps you out. Because today, we're pulling back the curtain on something almost nobody talks about. What banks actually do with your income information, why they ask for it the way they do, and, most importantly, how understanding this completely changes how you should be approaching every single financial conversation you have with a lender. Let's get into it. Look, when a bank asks for your income, most people assume it's a simple check. Do you make enough money to pay us back? That's it. That's the whole thing, right? Wrong. Here's what most people don't realize. Your income figure is not just an approval threshold, it is the starting point of a profitability calculation. The bank isn't just asking, can this person repay us? They're asking, how much can we charge this person and for how long before they figure out a better option? That is a fundamentally different question. When you report your income, the bank plugs that number into something called a debt-to-income ratio, your DTI. And your DTI doesn't just determine whether you get approved, it determines what tier of product you get offered. Here's the math. Let's say you make $60,000 a year. That's $5,000 a month gross. The standard guideline most lenders use is that your total monthly debt payments shouldn't exceed 43% of your gross income to qualify for most conventional loans. That's $2,150 a month in debt payments. Now, here's where it gets really interesting. If your DTI is on the lower end, say 20%, some lenders will actually offer you a worse interest rate than someone with a 35% DTI. Why? Because you look like a borrower who pays things off quickly and doesn't carry balances. You're less profitable. The person drowning a little in debt, they're going to pay interest for years. That's the customer banks quietly love. And this is the part that gets under my skin a little, if I'm being honest. When you walk in and volunteer your income number without being shown any products first, you've just handed the bank an anchor. In behavioral economics, anchoring is when the first number introduced in a negotiation disproportionately influences every number that comes after it. So think about this. You make $85,000 a year. You say that up front. The banker now knows your ceiling. They know roughly what payment you can absorb each month without flinching, and they can reverse engineer a loan product, the length, the rate, the fees, that lands you right at the edge of what you can handle. There's a reason car dealerships ask, what monthly payment are you comfortable with before they ever show you a price? Same psychology, different industries.
A study from the Journal of Consumer Psychology found that when people anchor on a high income figure early in a financial conversation, they're significantly more likely to accept higher total loan costs because the monthly payment still feels manageable relative to what they earn. You're not thinking about the $11,000 in interest over 5 years. You're thinking, yeah, $340 a month is fine. That's not a bug in the system. That's a feature. Now, you might be thinking, Thomas, banks are regulated. They can't just exploit me. There are laws. And you're right, there are laws, and banks follow them. But following the law and acting in your best interest are two completely different things. Here's what a lender builds from your income data. First, your maximum exposure. They calculate the largest loan balance they can legally offer you given your DTI, your credit score, and your income. This isn't the amount they think you need, it's the amount they think they can get approved. Second, your rate tier. Banks use income in combination with your credit profile to slot you into rate buckets. Two people with identical credit scores but different incomes can get different rates because income signals stability, and stability signals long-term customer value. Third, your cross-sell potential. And this one almost nobody talks about. When a bank takes you on as a borrower, they're not just thinking about this loan. They're thinking about the mortgage after your car loan, the home equity line after your mortgage, the investment account after your equity line. Your income tells them how far up the product ladder you can eventually climb. You are not a customer. You are a lifetime revenue projection. Let me make this concrete with a real example. Let's take two people, both applying for a $25,000 personal loan over 5 years. Person A discloses their income up front, $75,000 a year, low DTI, gets offered an 11.5% APR because the bank knows they can handle it and probably won't shop around aggressively. Person B comes in, gets pre-qualified first, understands the rate environment, and then provides income documentation as required. Same income, same credit score, negotiates to 8.9% APR based on competing offers they brought in. Over 5 years, the difference in total interest paid? Person A pays roughly $8,200 in interest. Person B pays roughly $6,200 in interest. That's $2,000 just from understanding when and how to provide your financial information rather than front-loading it in good faith. Multiply that across a mortgage, we're talking tens of thousands of dollars.
Okay, so what's the actual move here? Because I don't want this to just be an interesting video. I want you to walk away with something actionable. Step 1. Get pre-qualified before you walk in. Use online tools, bank websites, credit unions, aggregators like Bankrate or NerdWallet to get a range of what you'd qualify for before you sit down with anyone. This sets your anchor, not theirs. Step 2. Never lead with income in a conversation. Let documentation do the talking. There's a difference between volunteering your income in small talk and providing it on a formal application. In casual, early conversations with a lender, you don't need to blurt out your salary. Let the conversation be about the product first. What's the rate? What are the terms? What does approval look like? Then you complete the formal application where income disclosure is required. Step 3. Always bring a competing offer. This is the single most powerful thing you can do. Walk in with a written pre-approval from another lender. Banks will move on rate to win your business. A study by LendingTree found that borrowers who compared at least 3 loan offers saved an average of $1,500 over the life of a personal loan. On a mortgage, that number climbs to $28,000 over 30 years. Step 4. Know your DTI before they calculate it for you. Add up your monthly debt payments. Divide by your gross monthly income. That's your DTI. If it's above 36%, work on reducing it before you apply. Every point of DTI improvement can bump you into a better rate tier. Step 5. Understand the loan's total cost, not the monthly payment. Ask the lender for the APR and the total interest paid over the life of the loan. Put it in writing. If they're reluctant to show you that number clearly, that is your answer. Look, I want to be clear about something. Banks are not evil. They're businesses. They have shareholders and operating costs and employees. I get it. But here's the thing. They are extraordinarily good at their business. And most of us walk into these conversations completely unprepared, giving away information freely, trusting that the person across the desk has our best interests at heart. Some of them do, genuinely. But the system they operate within is built to extract the maximum sustainable value from your financial life over the maximum possible time. The only way to navigate that system effectively is to understand it. Not to be paranoid, not to refuse to work with banks, you need them, but to walk in informed, strategic, and clear on what the transaction actually is. Your income is not just a number, it's data, and data has value. Treat it like it does. If there's one thing I want you to take from this video, it's this. Financial literacy isn't about being suspicious of everyone. It's about understanding the game well enough to play it in your favor. Every loan you take out, every rate you accept, every payment plan you sign, Those are negotiations, and you cannot negotiate well from a position of ignorance. The people who build real wealth over time, they're not smarter than you, they're not luckier. They just learned, usually the hard way, that financial institutions are always playing chess while most people are playing checkers. Today, you just learned one of the most important moves on the board. So go run your DTI, pull competing offers before your next loan application, and next time someone across a desk asks you what you make, take a breath, smile, and say, let's talk about the product first. If this video helped you think about money differently, please hit that like button. It genuinely helps this channel reach people who need to hear this stuff. Subscribe if you haven't already, and drop a comment below. What's one financial assumption you held for years that turned out to be wrong? I read every single one. I'll see you in the next video.